All right, that is the big breaking news on ET Now right away. The CPI inflation is at 5.4% versus our own poll of 5.3%. This, of course, is a lot higher than the 5% it had been reported in the month of October. So remember, the November CPI inflation is at 5.4%. I'll get you internals in just a while, but if we have Mythili, Bhusnurmath, Anubhuti, Sahay and Aditi, Nayar, I'll take it across to them. Mythili, very quickly, your quick take. Food inflation has gone up to 6.07%. The CPI headline figure is at 5.41% versus 5% in the month of October.
Well, Supriya, the increase in the headline inflation to 5.4% is largely on expected lines. The worrisome thing really is about food inflation. At over 6%, it does seem as if food inflation is once again edging up. And given the importance that food plays in the consumption basket of the average Indian, and given the spillover effects it is likely to have, especially on inflationary expectations, this does begin to get a little worrisome. Of course, this morning we saw that WPI is still in negative territory for the 13th month in a row. But CPI at 5.41 is a 5-month high. So we have a situation of a 5-month high inflation, 5-year high inflation, and a 5-year high on the industrial production front also. So these are very low numbers. Ordinarily, we would have suggested that both industrial production and inflation looking up 5-year highs on both fronts would seem to suggest that the economy is overheating. Fortunately for us, we're nowhere near overheating because both on inflation as well as industrial production, we're fairly within safe territory. In industrial production, it does seem to suggest we're below potential. Inflation, we are beginning to get into worrisome territory. But as of now, I think nothing very much to ring alarm bells at the moment. All eyes really will have to be on the Fed.
All right, all eyes on the Fed, and we'll continue to track a lot more on Fed right here on this show. But Aditi, to you very quickly, nothing to worry about as far as CPI at over 5.4% is concerned?
You know, at 5.4%, certainly the number is a little bit higher than what we had initially forecast. But in hindsight, having seen the kind of hardening in food inflation in the WPI numbers, then this kind of an uptake is not surprising. I think what we need to look at very carefully now is how much of this rise in food inflation is because of very, very short-term factors, like tomatoes or potatoes, or how much of it is really related to any short-term supply disruptions because of flooding in the south, and therefore will reverse over the next month or two, and how much is really because of systemic factors that would be much harder to bring under control. And I think that is what we need to really look at in terms of the trajectory. As of itself, 5.4% is not terribly alarming, and I would still expect the rest of the CPI inflation prints for FY16 to be under 5.5% without having the benefit of seeing the disaggregated data from today's release.
Anubhuti, you want to comment on that? Both my experts believe nothing to be too alarmed about, but we'll have to figure out how food is contributing to that. It's just food makes up for about 6.07% growth is how food inflation has seen. Of course, some of those seems to be seasonal factors and short-term factors because even the RBI had spoken about them, that anything other than food and fuel needs vigilance. What's your take on it?
This number is on the lower side than our expectation. We were looking at a 5.65%. So this number comes as a big breather, especially after the uptick which we saw in WPI earlier in the day. Even if you talk about food inflation at 6%, this was primarily driven, I assume it was primarily driven by higher pulses prices and tomato prices. Now, if we look at the first 10 days data in December for these two particular products, especially if you talk about the pulses space, we have seen a correction. We have seen a correction in just first 10 days, and my view is that probably we will see this correction going forward in December 2015 as well as in Jan 2016. So having looked at the headline number, having looked at the food inflation number, we remain pretty comfortable as far as the Jan 2016 5% CPI, 6% CPI target is concerned. And as opined by Aditi earlier, nothing to be alarmed about with this 5.4% print.
Mythili, you want to comment on that? Nothing to worry about as this figure is concerned. Do you agree with the assessment that CPI is likely to accelerate up until December before it begins to plateau out and reach within that comfort zone of the RBI, which is at about 5%?
Yeah, well, the RBI had said that by Jan 2016 it would be 5.8%. That was their target. Initially it was 6, revised down to 5.8%. So I think the RBI will definitely reach that target of 5.8%. It might be even a little less. So on inflation, I think the headline number is not the worrisome part. The worrisome part, Supriya, as I said earlier, is about the food inflation, because as it inches up, surely and successively it keeps going up, then the RBI's hands are a little tied. For the simple reason, monetary policy has a very minimal role, really, virtually no role whatsoever as far as food inflation is concerned. So you have food inflation inching up, monetary policy, which is a traditional, armory for tackling inflation, that is virtually helpless. So you have the RBI not able to do anything about food inflation, at the same time inflationary expectations, spillover effects, all that impacting headline inflation. So I think that really is the worrisome part of it now, that it is food inflation that is inching up and RBI has very little answer for that. The answer for that is largely within the government's arena. So it is fiscal policy, administrative policy, how the government manages food distribution. Those are the kind of things. What does it do in terms of pulse prices? Can it import? Can it crack down on hoarding? So that is a slightly worrisome part, that food inflation is inching up. RBI has very few answers to tackle food inflation. So as long as Aditi said, these are because of temporary factors, it's fine. But if it reflects a basic fundamental mismatch between supply and demand, then we are once again entering into troubled waters.
Alright, once again entering into troubled waters, and let me throw some data at our viewers before I take it across to Aditi. Food and beverage inflation is at 6.08%. Food inflation are known at 6.07%. Pulses and production inflation is at over 46%, and vegetables have gone up by about 44% as well, versus about 2.2% I think in the previous month. Aditi, you believe that is where the fault lines really lie? Pulses, vegetables, and like Mythili is pointing out, it has to be the domain of the government to check those numbers from rising.
Both pulses and vegetables are sort of repeat offenders in a sense. We've seen several episodes over the last so many years where one of these two items really creates a spike. Sometimes the spikes last 3 months. This time, of course, the pickup in pulses prices has lasted a lot longer, and certainly, because these are items of regular consumption, they do tend to have a major impact on household budgets as well as on household inflationary expectations, as Mythili has been pointing out. So it is worrisome. Pulses specifically, we've had a demand-supply mismatch between domestic production and domestic demand for many, many years, and we have seen that over the last couple of Kharif seasons, the production has stepped down. So I think 2013 being the peak year. After that, we have seen production coming down, and so there are interventions that are required to arrest that fall for one. And at least as far as the Rabi sowing is concerned, there's very limited solace we can take from the fact that while it's wheat where the sowing is still lagging to a large extent, at least things like core cereals and pulses have caught up or are better than the level of sowing that had been covered by mid-December last year. So I think first of all, increasing the area under coverage itself is something, that's where the interventions need to start, not just on the distribution side but on the production side.
Anubhuti, do you agree that especially as far as items like pulses are concerned, demand supply is so carefully balanced, so finely balanced? In fact, in the case of pulses, demand has always been excess of supply. But we saw it in the previous bout of inflation also under Dr. Subba Rao, that when protein items, there was a huge increase in prices, because as income levels rise, demand for these value-added products, higher products, value products, that increases, and the demand just does not match with the supply. So what can the government do to really ensure that in agriculture we address those structural issues and ensure that supply also matches demand as income levels rise?
A very, very important question, especially when we talk about RBI's medium-term CPI target of 4%. If we really have to reach that particular level, the government has to clearly relook at its whole food policy, especially if we look at a very simple policy, the minimum support price. It is primarily oriented towards two crops, which is wheat and rice. A similar kind of stimulus or similar kind of an incentive is not provided for pulse production, and that leads to a huge supply-demand mismatch between, as far as pulses are concerned. Even if you talk about, long-term structural reforms, for instance, irrigation, why only limit ourselves to pulses? If we look at the whole crop space, right from cereals to perishables like vegetables and fruit, we remain very vulnerable to monsoon. And this has been hitting us for 2 years in succession. It was the story back in 2009 also. So I think the government really needs to start focusing on improving the irrigation facility in most of in the farms, and that has to be addressed very, very urgently. Unless we look at the food space, both at the pricing, both at the pricing level, that is giving stimulus or providing the right incentive to produce higher amount of pulses, both in terms of providing them immunity or being less prone to weather-related issues. Unless these kind of issues are addressed, we'll not really see ourselves insulated from weather disruptions. We need to create this buffer because India inflation in the current environment has gained significantly from lower commodity prices. We need to prepare ourselves when commodity prices of oil as well as metal starts moving up, and that will have an impact on prices of all other commodities, especially if we talk about core inflation. And I do take the point that if we talk about the medium-term target, we have not created that buffer on the food side, which is under government's control at this particular moment.
Aditi, even assuming that the RBI does manage to hit that 5.8% target for January 2016, if we have the repo rate at 6.75 and inflation CPI at 5.8, that gives you a real return of just about 1%. And if you remember, the governor was on record that he felt that domestic savers need to get at least a real return of 1.5 to 2% in order to ensure that domestic savings do not fall, especially in financial instruments, which is the need of the hour. So what does this mean for the RBI's policy? On the one hand, you have a real return of barely little over 1%. Does this not go against the RBI's stated policy of ensuring a better return, real return for savers?
So I do think that the Jan inflation, of course, without having seen the breakup of today's data, I would still stick my neck out and say that Jan 2016 inflation is going to be well below 5.8%. So there is some margin over there. But really going forward and looking at what kind of moves we may expect from the RBI, I think at least as far as the next policy is concerned, which will be in early February, we don't expect to see any kind of rate action from the RBI until the budget from the central government is done and dusted and behind us, because that's really where we are going to now very carefully be looking for cues as to what is going to happen with the pay commission, what actually gets implemented by the central government, and then slowly over time, we'll be waiting to see what many of the state governments decide to do in terms of their own pay revision and how inflationary all of this sort of fiscal expansion really ends up being. As the RBI had said, it is quite possible that the central government at least would be quite focused on fiscal consolidation, and so they would to a very large extent look for either expenditure compression. Whether it comes from revenue or capital is a different issue, or really revenue augmentation to be able to manage the impact of the pay commission award. But at the state government level, perhaps it's not as clear cut that the fiscal discipline would be of the same order, and so some expansion of aggregate demand does seem to be likely. I don't think we at this point would assume that between the center and the states that there will be no impact on aggregate demand going forward. So I think that is an inflationary risk that we need to look out for. And of course, as we've been saying, what food management looks like next year, what the monsoon looks like next year, of course, is anybody's guess at this point. So I think we are in for an extended pause. If inflation does surprise on the downside like we expect it to, then perhaps sometime after the budget we could expect one rate cut, but I think it's going to be a bit of a ways away at this point in time.
Mythili, very quickly before we wrap this, what should be playing on RBI's mind? The Fed, the fact that inflation has continued to be in a comfortable territory, it's perhaps things beyond its control like food and vegetable inflation that are rising, the inflationary pressures that Aditi was talking about, the potential ones coming via the salary hikes or the union budget.
Fed and Fed. You may be fed up with thinking about the Fed, but I think that's the plight of all central bank governors all over the world. They must be just thinking and dreaming and having nightmares about the Fed action.
Fed up with the Fed is what Mythili Bhusnurmath's final word is. Thank you very much, Mythili, Aditi and Anubhuti, for joining us. with your perspective right here as we discuss and debate the CPI inflation numbers at 5.41%. It's higher than the 5% that was reported in October.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.